If you are a beginner trader, you might have heard the words active trading. Although you may be asking, what is active trading, and how can it help with my strategy? Active trading is a specific form of short-term investing that focuses on quick profits. Active traders have a lot of market information, so they act rapidly. There are many ways that active traders can work to become successful. Active trading is an approach utilized for different products and markets. However, active traders are generally associated with Forex, stocks, and futures. It isn't the type of approach that you take for retirement investment funds and relentless returns. Instead, this is often a strategy you employ for fast profits. Active traders focus on trading in choices that offer loads of volume in profoundly liquid markets. There are various guides and strategies that active traders use to open and close positions quickly. Now, before we go into the best active trading strategies, please take a moment to go down and hit the like button, and if you are not subscribed to our channel yet, go ahead and subscribe to Stock Monster to stay connected. Here are the top 4 active trading strategies. Number 1. Day trading. Day trading is the act of selling and buying stocks within a specific window of time. We're talking minutes or hours, intending to make a bunch of minimal profits that will add up to significant gains over time. A day trader might purchase a stock at 9:15 a.m. and turn around and sell it at 2:37 p.m. that same day. Day trading is perhaps the most well-known active trading style. It is often considered a synonym for active trading itself. As its name implies, day trading is the method of selling and buying securities on the same day. Positions are closed out on the same day they are taken, and no place is held overnight. Traditionally, day trading is done by proficient traders, such as masters or market makers. However, electronic exchanging has opened this up to novice dealers. Number 2. Position trading or trend trading. Do you need to ride enormous trends that fill traders with envy? You know the type of trend that goes on without taking a break, whereas other traders are on the sidelines waiting for a pullback? If you want to get long-term profit, then position trading is for you. Some people consider position trading to be a buy and hold strategy and not active trading. However, when done by an advanced trader, position trading can be a form of active trading. Position trading uses longer-term charts, any place from daily to monthly, in combination with other strategies to decide the trend of the current market direction. This type of trade may last for a few days to a few weeks, and sometimes longer, depending on the trend. Trend traders explore progressive highs or lows to decide the trend of a security. By bouncing on and riding the wave, trend traders point to an advantage from both the up and downside of market movements. Trend traders look to determine the market's direction, but they don't try to figure out any cost levels. Regularly, they hop on the trend after it has built itself up, and when the trend breaks, they usually exit the position. This means that trend trading is more complex in periods of high market volatility, and its functions are generally reduced. Before we jump to the next section, make sure to leave a like and don't forget to join Stock Monster by hitting the subscribe button. If we missed something important so far, let us know in the comments below. Number 3. Swing trading. When a trend breaks, swing traders usually get in action. There's usually a little price volatility at the end of a trend as the new trend tries to set itself up. Swing traders purchase or sell as that cost instability sets in.
Swing trades are typically held for more than a day, but are shorter than trend exchanges.
Swing traders frequently make a set of exchanging rules based on technical or crucial analysis. These trading rules are outlined to distinguish when to buy and sell a security, whereas a swing trading algorithm does not need to be correct or foresee the top or value of a costly move. However, it does require a market that moves in one direction or another. A range-bound or sideways market may be a chance for swing traders. Now here's what I'd like to know. Do you prefer position trading? Why or why not? Add a comment below and share your thoughts. Number 4. Scalping. Scalping is one of the fastest strategies used by active traders. It exploits different cost gaps caused by bid-ask spreads and order flows. This strategy works by making the spread or buying at the offered cost, and then selling at the proposed price to distinguish between the two cost points. Scalpers hold their positions for a short period of time, decreasing the chance associated with the strategy. Additionally, a scalper does not attempt to misuse critical moves or move high volumes. Instead, they try to take advantage of minor moves that happen regularly and move shorter volumes more often. Since the level of benefits per trade is small, scalpers explore more fluid markets to extend the frequency of their businesses. Not at all like swing traders. Scalpers like quiet markets that aren't inclined to sudden cost movements. This allows them to make the spread over and over on the exact bid costs. Costs inherent with trading strategies. There's a reason professional traders only employ active trading strategies. Not only does having an in-house brokerage house diminish the costs related to high-frequency trading, but it guarantees better trade execution. Lower commissions and better execution are two elements that move forward the profit potential of the strategies. Powerful hardware and software purchases are typically required to implement these strategies successfully. In addition to real-time market information, these costs make dynamic exchanging somewhat restrictive for the trader, although not altogether unachievable. That's why detached and ordered techniques take a buy and hold position, offer lower expenses and trading costs, as well as lower taxable occasions within the event of providing a profitable position. Active traders can utilize one or many of the strategies mentioned earlier. However, before choosing to engage in these strategies, the risks and costs related to each one must be investigated and considered. So what is your preferred strategy? Let me know in the comments. Make sure to subscribe to the channel Stock Monster, like the video, and hit the notification bell. See you in the next video.